Yeah. In this session, let's start looking at the capital budgeting from the dimensions of the valuations and probably how do I take accept or reject decisions for different kinds of capital projects. How do I get into the valuation processes or NPV and IRR computation processes for different kinds of capital projects, and what are the various mechanisms that are available to evaluate the capital projects. These are some of the major elements that we would be looking. And just to give a small overview, whenever we talk about capital budgeting, it involves a long-term cash flows, right? Probably I am investing very heavily today, but the cash flows out of that particular investment, the benefits out of those investments will be over a slightly longer period of time, beyond one financial year. And generally we look at doing this kind of capital budgeting analysis either for expanding our business or replacing existing products or equipment, or probably some kind of pet projects of the senior management, or some kind of society related projects which are more mandatory. All these things can come under the capital budgeting process, right? Looking at the various types of capital budgeting projects that are available, now our focus is to get into how do I really evaluate the worthiness of these capital budgeting projects. How do I evaluate the worthiness of these capital budgeting projects? So if it is an expansion project, how do I look at it? Or if it is a replacement project, how do I evaluate the worthiness of that project? So these are some of the things that we are going to look at in this session. So with that as a base, let's jump into it. So whenever we are trying to evaluate any capital project, we try to work out three different calculations. One, what is the initial outlay? Means how much did we really invest, or what is the initial investment in the project. Then find out regular cash flows, annual or whatever are the period we are looking at, regular annual cash flows that we are going to get from the operations. So find out that particular number. And the third one is the terminal non-operating cash flow. The reason is at the end of the project we are no more going to operate the project. Whatever are the assets that we are left with, or whatever the products or equipment we are left with, we are going to sell that off and get some cash flows out of it. So that's where we call it as terminal non-operating cash flows, and probably after tax. Even this annual cash flows is post-tax, even this cash flows is post-tax. So wherever we are evaluating any capital project, we look at these three types of cash flows and then evaluate by finding out the NPV or IRR of the project. If I typically look at an expansion project, so the initial outlay will be the investment that I am making in fixed costs, which is purchasing some fixed assets like machines or equipments. So whatever is the fixed costs I am incurring, plus whatever is the investment in the net working capital. The investment in the net working capital is nothing but the change in the non-cash current assets minus the change in the non-debt current liabilities. So that is what we are calling as net working capital investment, right? Whatever is the change in the current assets minus the change in the current liabilities, which does not include the short-term debts, that is what we are calling as net working capital investment. So if that change is positive, it means I definitely require additional financing, so it becomes a cash outflow. But if it is negative, it becomes a cash inflow, right? So probably it's like saying the last year the current assets are 20,000 and now the current assets are 25,000. Means there is an increase in the current assets which will decrease the cash by 5,000. Alright. Now the current liabilities last year were 30,000. Now they have become 35,000 or 40,000. So there is an increase in the current liabilities by 10,000. So there is a cash increase by 10,000. Cash decrease by 5,000, cash increase by 10,000. The change in the working capital for me is nothing but there is an increase by 5,000. The current assets have increased by 5,000. Current liabilities have increased by 10,000. So the difference is negative, minus 5,000, which is what is saying that the cash is generated in the project. So the working capital, net working capital investment is it's a cash inflow, whereas if this comes out to be positive, I say that it is a net cash outflow. So that's one thing we would be doing. And whenever we are talking about regular cash flows, what we typically see in regular cash flows, revenues minus expenses, and whatever I require post-tax cash flows. So what becomes revenues minus expenses minus depreciation actually will give me EBIT, right? But out of this EBIT, I should add back the depreciation, but on this EBIT, let's assume there is no interest. So this itself will become EBT and tax is applied on EBT. But what should happen? The tax should, when I am adding back the cash flows, I am adding back the depreciation. But the depreciation that I have to add back, when I am adding EBIT plus depreciation, or it's as good as saying revenues minus whatever the tax rate that is applied, EBIT into 1 minus T plus the depreciation, because I have to pay the tax on this particular portion. So EBIT into 1 minus T plus depreciation will become my regular cash flows. And when it comes to terminal, so at the end of the period, I am selling off all the assets, so it depends on the salvage value. I get my net working capital back, and if at all the salvage value is more than the book value, means every year actually I am depreciating the asset by some amount, and by depreciating it by some amount I am getting a tax benefit, because my expenses are increasing, my profits are decreasing, which will result in a lesser amount of tax. So I am getting a tax benefit of DT every year. I am getting a tax benefit of DT every year. Whereas when I am talking about selling it at more than the book value, it means whatever the tax benefit that I have got, I have to forego to that extent of excess. So that's where I am subtracting the tax and finding out the terminal non-operating cash flows. And similarly, whenever I am looking at a replacement project also, the only differences I may have to look at is in the replacement, the initial outlay will also include probably the old equipment that is sold off. The benefit that I am getting, or the post-tax benefit that I am getting by selling off the old equipment. Sometimes I may sell it at a profit, or probably I may sell it at something lesser than the book value also, but whatever it is, I will get that particular cash flow also as a part of initial outlay. Sometimes it may decrease the initial outlay by that much extent of benefit I am getting by selling that old equipment. And same way, whenever I am talking about regular cash flows, my focus is not just on the new machines cash flows, but more on the incremental cash flows. If at all the old machine was there, what were the revenues? But whereas if at all the new machine is brought in, what is the excess? The excess of revenues, excess of costs which the new machine is going to bring compared to the old machine. So only the deltas, only the incremental values of revenues, expenses, everything are considered when we are doing the valuation of a replacement kind of a project. So what we should now look at is take up one example. Let's say for expansion project as well as for replacement project, and try to find out the worthiness of the project using the NPV as well as IRR analysis for that. Alright. See, sometimes we typically say, let me just go through something. How does depreciation play a role in terms of cash flows? Okay, let's assume revenues, expenses, depreciation. So let me assume revenues in two methods are 100. The expenses, fixed as well as variables, are also same in both of them. Let me assume that this is an accelerated depreciation method, whereas this is a straight line depreciation. So let me assume here depreciation is 25, whereas here the depreciation is 10. So from here I will get my operations profit or EBIT, right? I'll get EBIT as 25, whereas here the EBIT is 40. And similarly, when I am taking out the interest for simplicity purpose, let me assume 0 in both the cases. So EBT is 25 and 40. Assume that the tax is, for simplicity purposes, around 40%. So tax is 10, making the net income is 15 here, and 40% is 16, bringing the net income of 24. And now when I have to find out the after tax cash flows, post tax cash flows in both of them, what is the cash flow here? EBIT into 1 minus T. So 25 is the operating profit into 1 minus T. Tax rate is 40%, so 0.6 plus the depreciation, which is working out to 25 into 0.6 is 15. 15 plus 25. 40 is the post-tax cash flows here. Whereas when I am going with the straight line mechanism, EBIT 40 into 1 minus T, 24 plus 10, 34 is the post-tax cash flows here. 24 plus 10, post-tax cash flows here is 34, whereas in this case it is 40, which means if I am using an because the tax that is going up, in this method the tax is much lesser, whereas in this method the tax is higher, which means the post-tax cash flows in the straight line method are lesser by 6 compared to post-tax cash flows using an accelerated depreciation method. So that is what we are trying to talk of here. Though we are saying depreciation is a non-cash expense, but because of the tax that is involved, it may so happen that my after-tax cash flows will be different, and they will be higher if an accelerated depreciation method is used because of lower taxes compared to when a straight line or conservative kind of a depreciation mechanism is used. And for doing all kinds of capital budgeting analysis, we use the spreadsheets very heavily. So with that as a base, let's start off with one of the numerical examples. We talk about one of the projects which is more of an expansion project, wherein we are looking at the initial investments in terms of fixed costs of the equipment as well as the net working capital. Right, so let's try to put up the three major stages of our project, and based on that we can get a much more clarity in terms of the application part. Right, so let me use the spreadsheet for this purpose. Okay, let me take it as expansion project. Alright, I am dealing with an expansion project. Here I can look at the three phases as I suggested. And what is the life of this project? It's a 5-year project. Okay, so what I can very well look at is I can create year wise. Year 0, which means initial, after 1 year, after 2 years, 3 years, 4 years and 5 years. Okay, I want to look at the cash flows in each of the periods. Now the initial, in the first year, what is, or probably at the beginning right now, what all are incurred? The fixed costs are probably the cost of the equipment as well as the net working capital investment. These are the two cash flows that are involved. So the initial outlay part will include whatever is the cost of purchasing that asset versus whatever is the net working capital investment that is required on that. So all I can do is the cost is a negative cash flow of 60,000, whereas the working capital is a negative cash flow of 20,000. So overall the total investment in the cost, total cost, probably we can add it up slightly later, but the initial outlay is to the extent of 80,000. That's the first part. That's the first part wherein because it's an expansion, I don't need to adjust with the cash flows from the old equipment or from the old project. Next, when I am looking at this project is having a life of 5 years, so for that I have I am planning to prepare the cash flows and the financial statements for the 5 years. The salvage value is 24,000. So we have to look at this aspect, the salvage value being 24,000, and we always need to look at what is at what excess to the depreciated value is the salvage value. So based on that, add that salvage value and even the tax based on that excess. We'll get into that aspect. So coming to the operations part, each of the years, so that's the second thing that we need to get in regarding the operations of each of the periods. I can very well consider the revenues, annual revenues. Okay, I'm taking up the revenues, wherein each of the year the revenues are to the extent of 100,000. Are they growing? No, every year the annual revenues are to the extent of 100,000 only. Okay, so these are the revenues in each of the years. Then what are our costs? The variable costs are 50% of the revenues. Okay, so variable costs in each of the periods, I am taking it as 50% of the corresponding revenues. Okay, so these are my variable costs. Then fixed costs excluding depreciation is 12,000. So let me include even the fixed costs. Fixed costs excluding depreciation, they are 12,000, which are the same across. Probably these things can change year over year. Now this is where I would also look at the depreciations, right? This is where I would look at the depreciation for each of the periods, and it is said the depreciation rates are 14, 25, 17, 13 and 9. These are the depreciation. So probably whatever are the numbers, I will take the depreciations. In the first year it is 14%, right? 14% of the cost. So the depreciation in the first year is 8400. In the second year it is 25% of the cost. So here I don't take net working capital, and for the third year it is 17, 13 and 9. So I'll take it as 17, okay, 13 and 9. Okay, so these are my depreciations for each of the years. So once I do all these things, I get my EBIT. For each of the years, I'll get my EBIT as the revenues minus all these expenses put together. So this is what is resulting in the EBIT for the project for the next 5 years. Right, once I have the EBIT, I don't have the interest, so probably I can consider the taxes. Now in this case, the taxes for me are, what is the tax rate? 35%. So the taxes for me are 35% of the EBIT. 35% of the EBIT, working out to 10,360 is the tax in the first year, and it is changing at this rate for the next few years. And from here I can find out the net income after tax. Net income after tax, okay. So the net income after tax is coming out to be 19,240 in the first year. And finally these are the numbers. Now for this, the net income after tax, I can add back the depreciation, or probably I should do EBIT into 1 minus T plus depreciation, whatever it is. So to get the cash flows, if I am adding depreciation, either of the ways, if I am adding back the depreciation of these numbers, so what are my post-tax cash flows? Both the ways I can do. Post-tax cash flows. Operations. Operating cash flows only. Post-tax operating cash flows are working out to be these numbers. The same way I get my post-tax operating cash flows by doing EBIT into 1 minus T plus dividend. Even the plus depreciation. So EBIT, let's try this, into 1 minus T, 35% is the tax rate, plus the depreciation. So even this will result in the same. So either of the way, from the net income whatever you are getting, you add back the depreciation, or you do an EBIT into 1 minus T and add back the depreciation, whatever it is, that will become your after tax operating cash flows. And when I am looking at when we are looking at now the third aspect, which is the terminal, in case once the business is winded up, we call about terminal cash flows, terminal non-operating cash flows, whatever are there, non-operating cash flows, terminal non-operating cash flow. So in this, what is that we have? One, the salvage value, because I am selling off the asset at a particular price. What is that I am selling it? I am selling it at 24,000 bucks. So this is the cash that I am going to get. But as per the books, what is the value of the asset? I have already depreciated by this much. So the 46,800 of it has already been depreciated. So the book value that is still left for the asset is 60,000 minus of whatever has been depreciated till date. So if I remove that, 13,200 is the only book value, which means for the remaining 46,800 worth of depreciation, I have already got the benefit in terms of tax. So if I am selling it now at 24,800, that is a capital gain for me. So this is treated as a capital gain, and I have to pay tax on capital gain because I am selling it at more than the book value of the asset. So the tax that I am paying, that I am supposed to pay, is the difference between the salvage value and the depreciation. If the salvage value has been lesser, I will get a tax benefit as an inflow. Whereas if the salvage value is more than the book value, I will get I have to pay an additional tax on the gain that I have made at the end of the period. So the difference between these two is the capital gain, and on the top of that I am paying 35%, which is what is adding up to the tax on capital gain. And obviously in this case the return of net working capital will happen, which is to the extent of 20,000 bucks, right? So the terminal cash flow in our case, so probably I'll sum it up saying terminal net operating cash flow in this case is a component of post-tax salvage value, whatever is the additional tax I have to pay or receive because of the difference between the salvage value and the book value of the asset. So that is what is one, and my net working capital would be returned back, which is what is contributing to a net operating cash flow of 40,220 in the 5th year. So finally, when I look at the total after tax cash flows, right, total post tax cash flows for the entire project, in the first year or probably in the 0th year, I have invested 80,000 bucks, whereas in each of the 4 years I've got around 27,000, 29, 27 and all, whereas in the final year, along with EBIT, I have also got, along with the operating cash flows, I also got non-operating cash flows to the extent of 40,000, taking my overall cash flows to be around 66,000. And assume the weighted average cost of capital. The weighted average cost of capital, we have got it as 12.5%. This is purely divided. This is purely estimated based on the risk that is involved with the project. Based on this, I can compute the NPV for the project using my NPV calculators, wherein this is the rate, and probably these are the future cash flows, and probably I have to subtract the initial outlay to finally arrive at saying the NPV in this particular project is around 42,287, which means the there is a positive NPV in this project, which means it can very comfortably be taken up. And if I am talking about the IRR involved in the project, I could very well find out the IRR, and that works out to be around 30%. So which means on an average I am able to generate around 29.68% as the annual return out of this particular project. So because the IRR is much greater than the cost of capital, which is 12.5%, we can very well go ahead accepting the project. So in a nutshell, to summarize this scenario, whenever we are talking about any capital budgeting project, we are looking at three components in it. One is what is the initial outlay, which will include the fixed cost investment as well as working capital investments. Then we are talking about the net after tax operating cash flows for the period of the project, wherein to the EBIT into 1 minus T, we add back the depreciation and arrive at operating cash flows each of the years. And in the terminal year, when we find out the terminal non-operating cash flows, we primarily look at what is the increase of the salvage value over the existing book value. Corresponding to that increase, we have to pay an additional tax. Whereas when it comes to the overall cash flows, even the market values, the typical market value or a salvage value is what we are taking, because we will get a cash flow of 24,000 there. But because we are selling it at a gain, we have to pay an additional tax corresponding to that additional gain, and we'll get back the return on the net working capital, and which will work out to the terminal non-operating cash flows of 40,220, which from where I can find out the total cash flows, and which will lead me to the computation of NPV and IRR based on the weighted average cost of capital. Alright. Suppose we modify the above example slightly, saying that this is not an expansion project, but this is a replacement project, wherein our objective is to replace the existing machine. What was the existing machine details? We have an existing equipment which was purchased at 30,000 bucks 5 years back. Right, 30,000, it was purchased at 30,000 bucks 5 years back, and it has a life of 10 years, which means it can actually be used for the next 5 years. If it can be used for the next 5 years, but what we are trying to do now is we are replacing, though it can be used for 5 more years, I am replacing that particular machine with a new machine. So that is where I have to see the incremental benefit that I am going to get with the new machine vis-a-vis the old machine, and also the incremental revenues as well as the costs and depreciation that are involved, instead of taking the absolute values. That's one more major thing that I have to consider when I am looking at a replacement kind of a project, right? So all I should be looking at is, in case I was going with a replacement project, I will try to put it side by side here. The same project, in case I have to treat it on a replacement basis, if I am trying to put it exactly, if it was the old project, right now I am not much bothered about what had happened in the last 5 years, but I have to consider the impact of replacing it. right? And it is said it was depreciated on a straight line basis. So which means it was actually depreciated at 3000. The depreciation in that case was 3000 in each of the years. Whereas now the depreciation is much different. The depreciations have gone to 8,400, 15,000 kind of numbers. Means all the times whatever is the expense or the revenues that I am considering, I should only look at the deltas. Okay, let's see year 0, what would I consider? For the new machine, yes, the cost is minus 6,000, minus 60,000, which is an outflow, as well as minus here the net working capital will be increased by 13,000 instead of 20, because I might have got some cash by some working capital out of the older machine, so whatever it is. So now the net working capital is to the extent of 13,000 bucks. But along with that, in case of a replacement project, I will get a few more things which are more like proceeds from sale of old, because I have sold the old asset. How much I am going to get there? The salvage now the okay, currently it can be sold for 10,000 bucks. So I'll get 10,000, and at the same time the tax, whatever the excess I have sold, whatever is my selling price over the book value, for that amount I have to pay the tax. So now I have a tax also on the excess. Now what is the book value at that point? It was it was purchased at 30,000. 5 years on a with a 10-year life means 3,000 was the depreciation per year. So which means at the end of 5 years, its actual useful life was 15,000, or its actual book value was 15,000, but it was sold only for 10,000, which means there was a loss. So I have to get a benefit corresponding to that loss, which is nothing but the salvage value minus whatever is the book value that is existing at the end of the period multiplied by 35%, whatever is the tax rate. So basically it's like I am getting a tax benefit instead of a tax loss. So overall, including all these things, my initial cash outflow was this plus this, and I also got the proceeds from the, so this is an inflow, and the tax actually I have to subtract, means it is adding up, because that's also a benefit. So overall it was costing me only 61,000. Why 61,000? Yeah, 73, and probably these are adding up as the benefits. So overall the outflow was only to the extent of 61,250, because I'm able to sell the asset at 10,000, and at the same time I also got a tax benefit because I have sold it at a loss. So if I had sold it at a gain, then probably I would have incurred additional tax, which could have reduced this benefit. But because I have sold this asset at below the book value, I have incurred a loss, so I will get a tax benefit corresponding to this. So the initial period cash flows are something like this. Now what I will do in case of revenues and all is I am only looking at the incremental portions. When I am looking at replacement project, my focus is only on the incremental numbers. So revenues, no change in the revenues between old and the new. So obviously I will put in the revenues column I will put 0. Now the variable costs, old ones, they are 70% of the revenues, which means 70,000, whereas in the new case it is 50%, means 50,000. So the change in the variable costs, which is 50,000 minus 70,000, working out to minus 20,000 in all the cases, right? Because earlier there was a revenue of a variable costs of 70% of the revenues, where the revenues were 100,000. Now it was only 50% of the revenues. So there is a benefit of 20% of the revenues, working out to 20,000 as the benefit. Incremental variable costs. Incremental fixed costs is 0 because no change. Depreciation. Here it is 8,400, whereas in all the other years, if I had gone with the old machine, my depreciation would have been 3,000 for the next 5 years. So I will consider the incremental depreciations as this number minus 3,000 over the entire period. So these are working out to be my incremental depreciations. So from here I can find out the EBITs for each of the periods. Right, these are my EBITs. I can do the tax. The tax in each of these years is working out to 35% of the same. So this is working out as the tax, and probably a net income after tax is working out to this much. This is the net income after tax on each of them. And when I am working out with adding back the depreciation, here I am adding back only the incremental depreciation. What is that incremental depreciation? Only to the extent of this. So when I am adding these back, all I am getting is post-tax cash flows, which is summation of this plus this. So I am getting a post-tax cash flows of this, which again is nothing different from, probably if I had simply worked out as the change in revenues, right? Sometimes I can consider it like this: change in revenues 0 minus change in expenses, which is minus 20,000, minus the change in depreciation. Change in depreciation is this much, right? Change in revenues minus change in expenses minus change in depreciation. All these things. So basically delta S minus delta cost minus delta depreciation multiplied by 1 minus T, which is 0.65. And to this, if I am adding back the depreciation, what I am going to get is exactly the same. So either I can use this kind of a mechanism, or I can use the delta mechanism, wherein I can subtract the change in the variable costs and change in the depreciation from the change in the revenues to arrive at the incremental after tax operating cash flows. Now going ahead with the same. Now in case of the terminal, yes, that machine is already sold off, so whatever are left, these are the numbers here for terminal. I am selling it at 24,000 bucks. The tax gain that I am going to get, all these things will still remain the same because it's the new machine, right? Because it's the new machine, it is still depreciated by that much of amounts. So because it has already been depreciated, so when I am selling it at 24,000 bucks, the salvage value is still 3,000. I mean the tax on the tax is 3,780 because the book value is 13,200, whereas you are able to sell it at 24,000, and the return on net working capital is only 13,000. So in this case I can compute the terminal cash flows as 24,000 minus 3,780 plus only 13,000 as the return on the net working capital. So the terminal net operating cash flows this time is working out only to 33,220, and probably I can compute the total after tax cash flows in each of the years, which is working out to these numbers, and in the final year it is the summation of these two working out to this much number. And now when I am going with the same weighted average cost of capital, the NPV in this case is working out as NPV in this case is working out as slightly a positive number. NPV is working out slightly positive 11,000 only this time, whereas IRR will be slightly more than 12.5%, but will be much lesser than 29. So it is working out to somewhere at around 18.79 only. So which means if at all this project is treated as a replacement project, if at all this project is treated as a replacement project, then my IRR is going to be 18.79. The incremental revenues and the incremental expenses that my project is going to generate, and the incremental cash flows that the project is going to generate will lead to an IRR of 18.79% and a net NPV of 11,000. So since NPV is still positive, we can very well go ahead in terms of replacing the existing project also. So that's how we actually look at comparisons and evaluating, especially when we are involved in replacement projects or the expansion kind of projects. So this is the kind of calculation that we are supposed to take for both these kind of projects. Alright, now let's move further. Does inflation influence our capital budgeting decisions? Another important point to talk of. Does inflation play a role on capital budgeting decisions? And the simple way people answer to this is yes. The reason being, see, if the inflation is very high, probably my revenues, my expenses, all of them will go much higher, and which means the discount rate also should go higher, because if the inflation is very high, right, probably inflation is high, will lead to the cost of debt going up, and even the cost of equity will go up, which means the weighted average cost of capital, which is used as a discount rate, typically will go up, because whenever I am using the inflation, if we are typically talking about the cost of debt or equity, risk-free rate plus whatever is the premiums. And when I talk about the premium, there is one inflation premium also that is built into it, along with the maturity premium as well as a risk premium, which means if the inflation rate is going up, the inflation premium will go up, which will result in the cost of debt as well as cost of equity going up, which will also result in a weighted average cost of capital going up, which means the discounted rate that is being used to value the project also should go up. So one simple thing is, inflation has a very strong influence on the capital budgeting decision. So that's where what people say is, if we are including the inflation in the cash flows, please include inflation in the discounting rate also. Or in a simple way, if I am using the nominal cash flows discount them at a nominal rate of return, whereas if I am using real cash flows, if I am adjusting the cash flows for inflation, then probably I do not need to consider inflation in the discounting factor also, but maintain that consistency. If I am using inflation in the cash flows, use it in the discounting rate, otherwise don't use it anywhere, because the NPV will have a very big impact with the inflation. As we have saying, the cash flows will change and even the discounting factors will change, which could result in NPV getting very badly affected. And if the inflation is high, whatever the tax saving we are getting from depreciation, that is of not much of a use. Whatever the payment that we are making to the bondholders, even that is reduced. So revenues are impacted differently, costs are impacted differently. So in a way, what we could see is inflation will really influence the capital budgeting decision on a whole, right? So that's one more aspect that we have to be comfortable with. Then moving on to the next aspect, see, in the projects we have the situations of choosing between two or more projects. So there are typically different kinds of scenarios that we will discuss in this case, but especially when I have to evaluate two mutually exclusive projects, means the decision I can choose only one of the two but not the both. So those are the ones we are categorizing as mutually exclusive kind of a projects, and especially if they have different useful lives. So probably I have to make a decision between project A and B. Project A has a 3-year life, whereas B has 6-year life, but I can repeat this project at the end of 3 years, making it 6 years. Probably this is more applicable to an equipment purchase. Let's say I have to decide between purchasing equipment A versus equipment B. Equipment A will last for 3 years, whereas B will last for 6 years. But I am assuming that at the end of 3 years, I can again purchase equipment A, and that can happen on an indefinite basis. So that is where we are using this kind of process, especially when I have to evaluate capital projects which are having unequal lives but which are expected to recur for indefinite period. Even this has to be added to it. If I have such a kind of a decision making process, then there are two ways in which I can choose which project is more beneficial compared to the other. In that we talk about the two approaches, one being the least common multiple of the lives, which is also called as a replacement chain analysis. You repeat that for 3 more years, so that you match the timelines for both these equipments for an equal timeline, and after that you compute the NPV. So suppose this particular A has a 4-year life and B has a 6-year life. What it says is, you take the project's life as 12 years, which is an LCM between these two. So repeat this purchase after every 4 years, repeat this purchase after every 6 years, and assume the cash flows in the same pattern for the next set. So once that kind of a timeline is drawn, you can very well go further computing the NPV. That is what we call as the LCM of lives approach. So you create a time period for both the projects such that the timing, the total length of the project is same, by repeating the purchase n number of times so that it matches the LCM of both the lives, and then compute the NPV. That is what is the least common multiple of lives approach. Or on the other side, I could also look at the equivalent annuity approach. In that approach, what I would be doing is, I will not repeat the process. I'll compute the NPV once. For both the projects, I'll compute the NPV. And after that, I will find out the annuity value. Because this NPV is over a 3-year period, whereas for the other project, the NPV could be over a 6-year period. So take the NPV as the present value and find the annuity value, which is like a equal every year kind of a benefit. So you can find out the PMT by taking PV as the NPV and the number of years and the interest rate. Taking all these things, you find out the PMT, and whichever the project gives me the higher PMT will be the more profitable project compared to the other. But one thing is, whether I use the equivalent annuity approach or the replacement chain analysis approach, wherein the least common multiple of the lives is considered, both of them should give me the same decision. So we'll take one numerical to explore that, and then we'll come back to this understanding of the capital rationing part. All right. Okay, once we look at that approach, just one sec. Okay, the company has 2 investment choices. Okay, let me look at that aspect. Company has 2 investment choices: 20,000 in a 6-year useful life equipment. Okay, the company has to invest 20,000 bucks now, which can generate cash flows of 4,500 at the end of the first year. Okay, first year, so probably I'll call it as the cash, the time periods 0, 1, 2, 3, 4, 5 and 6. At the end of first year, 4,500 and increase by 500 every year until 6th year. So probably the cash flows are like 5,000 at the end of the second and so on up to the 6th year. Fair enough. So in this case, if I have to assume some cost of capital, so probably I'll assume that the cost of capital for this is 12%. So in this case, I will land up with an NPV of something like this, right? I'm landing up with an NPV of, let me convert it into numbers, 2,966, which is positive. So accept the project, and I will also land up with an IRR of somewhere around 17%, 16.7%. Because this is greater than the weighted average cost of capital, I can very well go ahead with taking up this project. But we are talking about mutually exclusive projects, wherein the second project, what it is saying is, invest 10,000 in a 3-year useful life project which can generate 5, 5.5 and 6 in the 3 years. So 5,000, 5,500 and 6,000 in the next 3 years. So based on this, if I want to compute the NPV, based on this is working out to around 3,119, slightly more than the earlier approach. And when I am looking at the IRR, probably this is generating somewhere much a higher figure of somewhere around 28.84%. So let me make a small modification to these numbers. Instead of 5.5, probably if I say phi 2, yeah, if I say phi 2 instead of phi 5, what we are seeing here is, for the first project the NPV is 2900, whereas for the second one is 2800. So if I am going by the NPV approach, it is looking like I have to prefer the first project, which is having a useful life of 6000, whereas when I am going with an IRR approach, I have to typically look at the second project, because the first project is having an IRR of 16.7, whereas this is 27.6, and at the same time the useful lives are different for both the projects. This is a 3-year project, or this is a 3-year worth equipment, and this is a 6-year worth equipment. So what is typically suggested is, when I have such kind of a pattern, make the useful lives of both of them the same. Right? One simple logic that is talked of is, make the useful lives of both the projects the same, which means you repeat this project again from here onwards. So because of that, what happens, I have to invest 10,000 again here in this year. I have to invest 10,000 and I will get 5, 2 and 6 in the next 3 years. So because I have to invest 10,000 here, my net cash flows will be minus 4,000, because I am getting 6,000, but I am putting up 4,000, which will but I am putting up 10,000 more, which is a cash outflow of 4,000. And similarly then I will get 5,000, 5,200 as well as 6,000, which means in this case I am making the lives of both the projects equal. Means I am purchasing the equipment second time at the end of 3 years for the same price, and I am expecting same kind of cash flows for the next 3 more years. So if that is the case, the NPV I am trying to find out is for this entire period. I'll find out the NPV for this entire period, which is resulting in 4,900, and even the IRR which I am finding out now will be for this entire period still resulting in the same 27.6% only. So the IRR does not change, whereas the NPV now has become 4,930, which is giving me a scope that I can very well go for project 2, equipment 2 compared to the equipment 1. So especially when I am dealing with 2 different equipments or 2 different purchases which have different useful lives, the replacement chain analysis mechanism, wherein I will extend the time periods of both the equipments such that the useful life is equal to their least common multiple, and I'll repeat the purchase of that equipment those many number of times with similar kind of cash flows over the entire period. That is where I will evaluate which project is better. That is what we call as the replacement chain analysis or the least common multiple approach. Whereas the second side, whatever the second method whichever I have, is called as the equivalent annuity method. In the equivalent annuity method, I don't repeat this like this. Right? In the equivalent annuity method, I'll still continue with the old process, only take the NPV only for that periods. But what I will do is, I know that this NPV is over a 6-year period. So I'll compute an annuity by using my PMT formula, wherein I will consider, okay, the rate being the weighted average cost of capital. The number of years in this case is 6. I equate the PV as the NPV. I take the present value as the NPV, and of course the FV I will take it as 0, and says in this case the present value, whatever is the 2,900 I am getting, the annual value equivalent of that, is 720 bucks, whereas in this case that same annual value equivalent is going to be, this is only having a life of 3 years, so the annual value equivalent of this is going to be around 1199. I don't need to consider the negative values because we are just seeing what is the annual value equivalent, because the years are different in both the cases. So I am trying to find out what is the equivalent per year. So the equivalent per year computed by the PMT mechanism in this case is slightly higher, close to 1200 bucks compared to 720 bucks. So that is why we are going ahead saying the project 2 is more preferable, or the equipment 2 is more preferable compared to the equipment 1, even going with the equivalent annuity kind of an approach. So especially when we are dealing with two different equipments or two different capital budgeting decisions, where the projects have unequal lives but they are expected to recur over for an indefinite period, I can use the least common multiple of the lives and repeat the same process until those number of years are met, or with one single period's NPV itself compute the annual equivalent value. That is where we call it as annuity, annual equivalent value, and see whichever the project is having the higher annuity value will be preferred compared to the other. So these are the two mechanisms to evaluate capital budgeting projects with unequal lives. Then the other concept that we have to look in this context is the concept of capital rationing, which is more of putting a size constraint on the budget. No company operates with unlimited capital. The capital is constrained. So within those set of constraints only, or within that budget that has been allocated only, the company has to adjust that capital or allocate that capital among all the set of available profitable projects. So probably it may so happen that there are 5 profitable projects for the company which require an initial investment of 1200,000 or probably 1.2 million dollars, but the company is having a constraint of the capital available is only $1 million. If that is the case, how can the projects be chosen such that the overall profitability of the company is maximized? That is where the capital rationing comes into picture, and the projects need to be chosen in such a way that the overall NPV of the combination is maximized. Because initially we may see that for the first project the cost would be cost of capital would be much lesser, whereas the benefit could be much higher. But as we are going for more and more capital, the cost of debt, cost of equity, all of them will go up, so the marginal cost of capital will keep increasing. So from a company's standpoint, it can go ahead with the investments as long as the return on the investments is greater than the marginal cost of capital. These are some of the things which we know. Any company can go ahead with the investment as long as the return on the investment is more than the marginal cost of capital. So looking at the small numerical, okay, the company is having a capital budget of 100 million, whereas the opportunities that are available, all 4 are profitable opportunities, but they together require 90, 120, 145 million. But the company doesn't have 145 million. So it has to choose in such a way that the overall NPV of the project is maximized. So they can think of choosing A and B. But if they choose A and B, the NPV is going to be 22 million. But if they choose, let's say, A and C, NPV is going to be 20 million. But if they choose B, C, D, removing A, which is having a high priority or which is giving the highest NPV. But if they choose B, C, D, it is still within the budget 40, 30, 25, 95 million. But the NPV is going to be 23 million. So, out of the various options that are available with the company, it should prefer the combination of B, C, D, because this is the combination that is generating the highest NPV. So, the remaining 5 million capital can be used for a slightly different purposes, or probably waiting for one more project, because the existing ones is giving me a higher NPV of 23 million. That is how we go ahead with the evaluation of the capital projects under the constraint of capital rationing. So this is one more numerical that you have to be comfortable with. Then, how do I assess the risk in the capital projects? Right? There are multiple ways of working out with the risk analysis or understanding the sensitivity of the output. The output is nothing but NPV and IRR. The sensitivity of the output with changes in the input. Let me just talk about some of these things here. Let's say in this example, any of the revenues, let's say I am increasing the revenues each of the period by 10% or decreasing them by 10%. If the revenues are increased or decreased, initially let me write down what is the NPV and IRR. Right, I'll just play with one or two. Currently the NPV is 42,287 and IRR is 29.68%. What I am more looking at now is, if I assume that the revenues are 110 instead of 100, means there is a 10% increase in the revenues every year and nothing else is changing. 10% increase in the revenues each year and nothing else is changing. What I am seeing is my NPV has directly become 53,859, whereas IRR has become 34.29%. Same way, this is what we call as sensitivity analysis. I am just changing one input variable and I am looking at what kind of impact that it has on the profitability of the project, or basically the measures of the project like NPV and IRR. So that is what we are calling as sensitivity analysis. Observe the impact of the output dependent variable. In this case, we thought that our output variables are NPV and IRR. By changing only one of the input variables and keeping all the other variables constant, that is what talks about how sensitive is that variable. So if that input variable changes slightly, it will have a very big impact on the NPV and the IRR of the project. Okay, when it has gone up, this would have been the situation. But what if it goes down by that same 10%? Let's say, what if it goes down to 90,000? Right, if all else remaining the same, let's say if this number goes down to 70, 90, what is happening? The NPV is coming down drastically. 30,715, there is a drop by 12,000 in the NPV, and IRR suddenly became 25%. So there is a drop in the NPV and IRR drastically. If that is the case, I can very well say that the sales or the revenues are very sensitive, or probably NPV is very sensitive to the revenues, So whatever the forecast of the revenues I am putting, if at all they change slightly, it may impact the profitability and the accept or reject decisions on the project very heavily. That is one thing that is given by our sensitivity analysis. So generally we plot a graph. If the x-axis is if the x-axis, which is the independent variable, is this much, what would be the dependent variable, and vice versa. So if this graph is very steep, it means that for a small change in the independent variable, the dependent variable is going to be affected very badly. That is how we look at the sensitivity analysis. Whereas in case of scenario analysis, what we typically think of is, don't change only one variable, because in reality probably if the revenues are changing, it may so happen that the depreciation may also change, or probably revenues are changing, even the variable costs also could change, or something else could change. So because of that, we don't know, we can't keep the remaining variables constant. It's always better that they change as a group. So that is where we talk about scenario analysis. Change multiple input variables together based on the economic situation. Let's say if the revenue goes up, probably the variable costs also have to go up, or something else might have to change. So all these things, change them as a package, and so probably create, okay, the best case scenario. If the economy is very good, what could be the numbers for all the input variables? What is the worst case scenario? If the in the economy being very, very bad, what could be the numbers? And probably the most probable case, or the typical regular kind of case, what are the values for the combinations of revenues, expenses, etc. In all these things, find out your NPV, and finally see how the NPV is changing for each of these scenarios. That is what we call as the scenario analysis. Then moving on to the next one, simulation analysis. Sometimes even it is called as Monte Carlo simulation. This is more like, you don't create scenarios like best case, worst case, or most probable case, because these are all human dependent. We are virtually assuming these values, and based on that computing our input, computing our NPVs and IRRs. But rather than that, if I say my input variables, let's say, are revenues, variable costs, and probably fixed costs, all these things, what I am thinking of is, I will assume one probability distribution to each of these independent variables. So let's say this revenues may follow a normal distribution with a mean growth of 10% and a standard deviation of growth of 2%. This is what I will consider for each of these. Okay, variable costs also probably may follow a normal distribution with around 60%, with a mean of 50% of the revenues and a standard deviation of around 5%. So by looking at a proper distribution and the parameters for each of these variables, we use a computer, we use a system to randomly generate one value for each of these things, and like this we generate some thousands of such scenarios. So we are not generating the values manually, we are asking the system to generate these input variables, which is more of an extension to your scenario analysis. Rather than thinking through 3 or 4 scenarios and primarily looking at what is your NPV and IRR in each of the cases, we are asking the system to generate thousands of such inputs based on some assumed distributions, and for each of the route we are computing the NPV, and finally seeing the distribution of the output. Distribution of the NPV and IRR is what we are looking at. This is what we are calling as simulation analysis, and especially when we are working with very small sample sizes where we can assume one distribution, this simulation or Monte Carlo simulation analysis is one of the powerful tools to assess in what range will the NPV lie, what are the most extreme values associated with the NPV and IRR. All these kind of things can be done quite comfortably using the simulation analysis. Alright. Now we will move on to the next aspect, wherein we introduce to the world of the real options. Right, that's one of the most important aspect. Probably the capital budgeting world or the corporate finance world took a very good development with the introduction of real options, which is nothing but the applications of derivatives, especially the options, to the capital budgeting world. So how do I look at those real options? How do I evaluate the projects in case they have real options inbuilt into them? We'll look at it as the next aspect. Alright. See, in normal situations, if I don't have options, what could have very well happened is, once I have made a capital budgeting investment in year 0, right, whatever the investment I have made, even if the project is going into losses in each of the years, I cannot back out of the project, or I cannot think of investing more capital into the project if the project is becoming more and more profitable, or I cannot think of changing my pricing if at all the project is becoming more and more profitable. So what we are seeing is, with the introduction of these real options, they are actually helping the managers to take a much better decisions based on the outcomes of what the capital budgeting decision is coming out. So if the capital budgeting decision is coming more and more profitable, they can go for expansions, price revisions, all those kind of scenarios. But if it is coming more and more negative, they can think of probably abandonment or something like that. That is where the real options are playing a major role, and for that, again, some premium or some kind of additional payments are being made to the other party for taking the risk for the same, or for protecting themselves against the risk. So all these things are today available in the market. So when I talk about the real options, we even look at from the perspective of timing. Instead of investing everything today, the company can look at this as a pilot, and in case it is seeing that the project is profitable, the small pilot version is profitable, then it can think of additional investment at this stage, rather than investing everything here and probably losing out. It will say, I will take a timing option wherein I will choose whether to invest more or not at the end of 1 year, depending on how the cash flows are shaping up at the end of 1 year. The company will take a decision, because generally the most important aspect in all these things, when I say the cash flows are 400, I am investing 1000 this year, I am getting cash flows of 400 the next 3 years. Remember, these are expected cash flows. So probably this expected is nothing but average. It can either go to 200 or 600 with equal probabilities, or this can go to 100 or 300 or 500, probably with this with a probability of 70%, right, and probably this with a probability of 20 and this with a probability of 10. Even this will work out to 400 as the average itself. So what we are simply saying is, these are not the defined kind of cash flows that I am going to get. There is an uncertainty in each of these cash flows which can be modeled through this kind of behavior. So, depending on whether I am going toward this side or this side, I will take a chance. If I am assuming that at the end of 1 year the cash flows are going toward this side, probably I may think of abandoning my project or reducing the prices or something like that. But if it is going toward this side, I can think of some other decision. That is where we are talking about, one, the timing, two, the sizing related. Either I can abandon the project, means I am not investing heavily, I am pulling out of the project, or expansion. I can think of more and more investment in the project in case I am seeing that at the end of 1 year this is going towards the profitable side. So that is where we talk about either abandonment option or an expansion option categorized under the sizing option, or I can have something to do with the operational aspects wherein I can get into my price setting decisions. I will change the price of the product. If at all after 1 year I am expecting a very good movement in the cash flows, I may increase the price, because if the demand is high, I will go for increasing in the price. I may not change the production quantity, but I will simply increase the price. Or in some cases, I may increase the production by paying something more to my workers, or I will increase the quantity of production. All these things can very well be taken depending on how the movement of the cash flows is happening over the period. And I can even think of fundamental options which are taking up additional projects based on the success of the original project. So the project themselves are options. So if the prices are low, or if the profits are increasing, or if the cash flows are improving at the end of the first year, I'll take up another project. But if the cash flows are not improving, I will not take up any more projects. So they are typically the fundamental projects wherein they are options in themselves. Okay, probably I'll take up a project only if these costs are low. Otherwise, I will not even take up the project. So those things go under the fundamental options. Now, one thing I would like to see here also is, how do I assess the worth of the real option? So if the option is present versus not present, is there any difference? And if there is a difference, how do I compute the worth of that particular project or worth of that particular option? So in this case, it's a simple project which I am taking. It's a project which is for a duration of 3 years, where the initial investment is this much, and I am expecting these cash flows over the next 3 years, and the beta of the project being this, risk-free rate, expected market rate of return, all these things. But at the same time, there is an abandonment option that is taken on the project, that I have the option to abandon the project at the end of first year. And if I abandon the project at the end of first year, I can sell off all those assets, whatever I have invested. I can sell off all those assets and get a salvage value of 1 million. So I have to really assess at the end of 1 year, if at all I have this option, instead of progressing for whole 3 years, if I have an option to take a decision at the end of 1 year, and in case I exit out of the project at the end of 1 year, I am going to get 1 million of my salvage value. So which of these two scenarios would be preferred? And if at all I am preferring the second one, or if at all there is some benefit of this option, what is the worth of this option? So whenever our intention is to compute the worth or the value of the real option, the most important way to look at is find the value of the project without the option. Okay, first let me look at how do I compute the value of the project without the option. What are the cash flows involved in this? Okay, it's a 3-year project. Initial investment of 1.5. I'm going to get 0.6 in each of the 3 years. And I need to know what is my cost of capital, WACC, which is where I can use the CAPM mechanism in this example. So I can take risk-free rate of return plus beta of the project times the expected market return minus the risk-free rate of return. So in this case, the weighted average cost of capital works out as 7% plus beta 1.1 times RM minus RF is 5%. So this is working out to 12.5%. So weighted average cost of capital is working out as 12.5%, and based on that I can compute the NPV of the project without the option. In case the option was not there, the NPV of the project would have been slightly negative. The NPV of the project is a negative 0.07 million. So probably the better way to write this is convert this into dollars by multiplying it with the million. So there is a negative 71,000 as the NPV for this project. So I would have directly eliminated or avoided this project. If at all I am expecting 0.6 million cash flows over the next 3 years and my required rate of return is 12.5% per year, I would have safely avoided this project because this will result in NPV of around 71,000 negative. Now that I have the option available on this NPV, on this project, how do I look at this particular option? Okay, for this, it is said that the expected cash flows are 6 million, but I am assuming that there is a 50% chance of 0.3 million and 50% chance of 0.9 million. So it may so happen that at the end of 1 year, the project is going towards a success wherein we can generate 0.9 million each year, right? So if at all I am going to generate 0.9 million where there is a 50% chance. So assuming that I will generate 0.9 million in each of the years, in this case my NPV would have become, instead of 0.6, if I am able to generate 0.9, saying this project is going to be a success. So every year if it is going to generate 0.9, this would have resulted in a positive NPV of 0.57 million, which is working out to around 571,000 positive. Whereas if it has gone negative, if it has gone down, what would have happened? It would have generated 0.3 million in the first year and I could have abandoned the project and got 1. Means it would have given me a 1.3 million at the end of 1 year, and going with the same, the NPV would have been, so here let me correct it, the NPV in this case, I think I have calculated it wrongly. The NPV in this case is going out to 643,000. whereas the NPV in this case is going to be around minus 344,000. So obviously I have a 50% chance of this and I have a 50% chance of this. So from there I can find out the overall NPV by giving enough weightages, 50% times this plus 50% times this. So in this case it is looking like the overall NPV is actually positive instead of negative, right? If at all the option is present, and I am assuming that after that initially I am getting 0.9 and after that even in the next two periods also I am going to get 0.9, then the NPV is going to be this much, which is giving me a net NPV to the extent of positive 149,000. So from here all I could do is, if at all there was no option, the project was giving me minus 71,000 NPV, whereas if I had taken this option it is giving me plus 149,000 NPV. Here also I could have considered in the next 2 years instead of 0.9, if I had considered even 0.6 also, then it is still resulting in a negative NPV. My net is still a negative of minus 74,000, then I could not have even considered. But if I assume that if it is a success, in each of the years it is going to generate the same 0.49, this is resulting in a net positive of 149. So the worth of the option, the value of the option, if at all I have to consider, it is the NPV with the option minus NPV without the option. So almost 220,000 is the worth of the abandonment option, which means I have to, if I pay anything less than 220,000 per a party to take the risk of abandonment option, then probably I can very well get benefited out of it, because the worth of this option is assumed to be somewhere around 22,000. This is how we evaluate the worth of the abandonment worth of real options. If I take the option versus I don't take the option, what is the difference in the NPVs in both the cases? And the value when I take the option minus the NPV if I don't take the option, I go with both of them and find out the difference between the two to understand whether the option is useful or of no use in this kind of situation. I hope you are clear in terms of understanding the calculations involved under the real options and how do you evaluate the worthiness of the option. Now let's move forward. So as just a simple thing, find the NPV of the project without the option and then find out the value of the option by finding out the NPV of the project with the options. So either you can use decision trees if the scenarios are simple, but if the options are complex, it's better that you go with a standard option pricing models like a binomial tree or a Black-Scholes kind of approaches. Now, one important aspect as far as the capital budgeting scenario is concerned, there are so many pitfalls or the simple mistakes which people do as a part of the corporate capital budgeting analysis. See, I don't fit in, I don't look at the economic scenarios or industry scenarios very heavily while doing the analysis. See, especially when we are looking at, okay, the economy is really good, but barriers to entry for a particular business in an industry. Let's say the economy is very good, the industry is profitable, right? And let's say economic scenarios like barriers to entry are much lesser. So there is a lot of competition that comes into that industry, and because of that, the profitabilities will automatically come down. That kind of economic scenarios are typically not considered as a part of capital budgeting mechanism. And most of the times we observe that the templates that are used for computing NPV, IRR, they are some standard templates which are not customized for various projects, which means they are associated with a lot of model risk, which could result in varying outcomes. And in some cases, especially with the senior management projects, they generally put some optimistic projections of the revenues or even pessimistic projections of the expenses, or optimistic projections of the expenses, finally creating very optimistic cash flows and very higher NPVs. So especially where the senior management pet projects are involved, we have to be more careful in the assumptions that are being put towards the estimates of the cash flows. And in some cases, we tend to use the short-term returns for long-term investments. If especially I am talking about very high returns in the short term because of economic situation or because of growth phase in the industry life cycle, it may not happen that over the next 20 years we generate the same kind of returns. So because of the typical industry life cycle mechanism itself, after a few years we go more and more into a stable, matured kind of a phase, and even there could be a decline phase in the period, which means the long term rate of return that I have to consider for my discounting purposes or for projecting my cash flow should be completely different and need not be the same as the one which is used for the short term purposes. So like this, even the cash flows, no proper mechanism, overhead costs, no proper mechanism, the discount rate which is being used, it may not be in line with the risk of the project, because based on the risk we have to compute the discount rate, but it may not happen that the discount rate that is used is properly adjusted for the risk. Allocations of the capital, there could be issues, and if at all one idea is successful or one idea's NPV is looking more and more positive, it may so happen that the management may not generate alternative ideas to a particular project, thus hampering the possible opportunities where even more profitabilities could be generated, and the sunk costs, opportunity costs are not handled properly to accommodate or to reflect the reality picture. All these issues are associated with any capital project, so enough care has to be taken while evaluating the worthiness of the capital projects. Now, the other important concept that is worth looking at in this context is the difference between economic income versus accounting income. Accounting income is nothing but, we look at it from the perspective of net income, which is nothing but revenues minus expenses. Of all expenses, it could include even the interest, taxes, everything, and even the depreciation. It is based on the original cost of the investment. So it's basically a book value based. Whatever the final income that I am getting is as per the accounting books, following GAAP or IFRS kind of mechanism. But when I talk about economic income, it's the same accounting income, but going with the market values rather than the book values. So when I look at a project's economic income, I'm looking at it from the perspective of market value but not on the book value of the asset. So that's where we don't use the word called depreciation when I am computing economic income. I use the word called economic depreciation, which is again the reduction in the market value of the project or the market value of the investment from period to period. We'll look at one simple numerical which can help us address this entire understanding of the economic income versus the accounting income. Okay, let's look at this simple example. We are talking about purchasing an equipment whose cost is 600,000, which will long last for 5 years, and it is expected that it will be fully depreciated in 5 years, which means if I am considering a straight line depreciation method, then probably I am using 120,000 as a depreciation for each of the years. But I am expecting that I will sell off the asset at 25,000, though I am fully depreciating it, which means in the 5th year I am expecting a capital gain of 25,000 at the end of 5 years. The tax rate is assumed to be 35%, and the project is financed at 50% debt, which is borrowed at 7%, and 50% equity, where I am expecting the cost of equity is 17%. And we are also making an assumption that all the income, because at the end of 5 years the project is closed, all the income is distributed to the lenders as well as equity investors in the form of dividend, and at every year the company is maintaining a 50% debt to value ratio. We'll use these things. We may not use all these things as a part of computation of the economic income, but the same example I'll use even for computing economic profit, residual income. We'll use few more concepts in the next part, wherein we'll talk about all these aspects. Okay, coming to the revenues, we are expecting that they are 50,000 at the end of 500,000 at the end of the first year, and grow up by 50,000 every year. Variable expenses being 40% of the revenues, and finally fixed expenses of 60,000. So if these are some of the numbers, how do I compute one, the NPV of the project? How do I look at it from the economic income perspective as well as accounting income? How do I make out what is the economic income and what is the accounting income in each of these cases? So first of all, compute the cash flows, right? Once you compute the cash flows, probably we can look at the economic income or the accounting income in each of the cases. So that's where I'll look at year 0, right? This is a 5-year project, right? So I'll say year 1, year 2, year 3, year 4 and year 5. These are the 5 years. Initial year, the initial costs, which is going to be 600,000, and there is no other costs, initial costs. Now after that there are the revenues. Okay, I am expecting that the revenues in the first year are 500, but they are going to increase by 50,000 every year. All right. So in the second year the revenues are going to be 550, 600, 650 and 700. These are the numbers of the revenues. Then we are talking about the variable costs, which are 40% of the revenues. So these are the variable costs in each of the years. Fair enough. And I am expecting fixed costs to be around 60,000 every year. All right, the fixed costs are going to be 60,000 every year, right? And now comes the depreciation part. So with that existing scenario, the depreciation, we are depreciating the asset fully. So 600,000, I am depreciating it fully over a 5-year period using the straight line depreciation. So overall, these are the numbers that are coming out, from where I can find out the EBIT for each of the years. So the revenues minus the summation of all these expenses is what is leading to EBIT. And so if at all I want to find out from this EBIT, if I want to find out after tax cash flows, we say that EBIT into 1 minus T. If I want after tax cash flows, post tax cash flows, we have said that it is EBIT into 1 minus T plus depreciation. So EBIT into 1 minus, what is the tax rate here? 35%. EBIT into 1 minus T plus the depreciation, right? EBIT into 1 minus T plus the depreciation is coming out to post-tax cash flows from operations. So these are the post-tax cash flows from the operations. And even when I talk about the salvage value, I'm planning to sell the asset at 25,000 means and if I look at the depreciation, it is entirely depreciated. So this 25,000 is a gain. So when I'm saying tax on capital gain or the salvage value, I'm taking 25,000 minus the book value, which is 0, into whatever is the tax rate. So that much. So the net salvage value for me, or probably a post-tax salvage value, is going to be the difference between the two. So 25,000 minus 8,750 working out to 16,250. So if at all I have to find out the total after tax cash flows for the entire project, so the initial year cash flows are going to be 600,000, whereas for the next years, for the next 4 years, these are the numbers. Fair enough. And for the last year, this is going to be this number plus this number. So using these, and if at all I want to find out what is my cost of capital, I have 50% in the form of debt and 50% in the form of equity. So how do I compute the cost of capital based on these two? The cost of capital is nothing but weightage of debt into post-tax cost of debt plus weightage of equity into cost of equity. So based on this, I can compute my weighted average cost of capital, weightage of debt into cost of debt post-tax 1 minus 35%, post-tax cost of debt plus weightage of equity into cost of equity 17%. So overall the weighted average cost of capital is coming out to around 10.78%. Right, the weighted average cost of capital is coming out to 10.78%, based on which I can find out the NPV of the project, which is nothing but NPV at the rate of 10.78%. These are the cash flows and this is the total initial outlay. So going with these kind of numbers, it's working out that plus 275,000 is the NPV of the project. Now from this, how do I compute the accounting income as well as, so if at all I have to compute the accounting income, straightforward, probably up to here, up to EBIT, things are the same, right? So up to EBIT, so if I have to look at computing accounting income, up to EBIT things are same for each of the years. Up to EBIT, the calculations will remain the same, and on the top of that, okay, now the interest has to be subtracted. What is the interest here? In each of the years, we were saying 50% debt. Oh, for that we are using this information. 50% debt to value ratio is maintained, right? So I have to really look at what is the composition of the debt each year. For that I require the working out with respect to the market values. So initially I will not look at accounting income. Initially I will look at economic income itself, right? So that I will get the market values, because accounting income is purely based on the market values based approach. So initial market value, I'll start off with this number, right? Initial market value, all I can say is beginning of the year market value is nothing but the present value of all the future cash flows, right? The present value of all the future cash flows is nothing but the beginning of the period market value. So in this case I can say net NPV based on this for all the future years, these 5 future cash flows, right? At the beginning of this year, the NPV is nothing but at the rate of 10.78% all the future cash flows. So it is coming out to 875, which is nothing but 275 plus the initial investment. So this is my beginning of the period NPV. Similarly, for each of the years I can do that, which will be the beginning market value of the asset, right? So I'll take the NPV at the same rate for this 4 years. So this will give me the market value at the beginning of the second year. Similarly, at the beginning of the third year, the NPV is going to be these aspects, which is 637. At the fourth year, the NPV is going to be these two things, which is going to be 469,000, and probably in the fifth year the NPV is going to be something like this, 263,000. So if at all these are the beginning of the period market values, I know that the end of the period market values are simply the beginning of the ones for the next year. So probably these are my end of the period market values. So which means there is a decrease in the market values each year. So the change in the market value is what we call as economic depreciation. So probably I will not call change in market value, I will call it as economic depreciation, which is nothing but the change in the market value of these assets. And I take the negative, because a decrease in the market value is a positive depreciation and an increase in the market value is a negative depreciation or an appreciation. So from this standpoint, if I look at the economic depreciation, it is working out to 103 in the first year, and it's working out to these numbers at the end of each of the periods. So what we are saying is, if at all I have to compute economic income, all I will be doing is I will subtract the economic depreciation. I will subtract the economic depreciation from the post-tax cash flows for each of the periods. So in this case, the economic income 198,000 minus 103. So the economic income that got generated in each of the periods is going to be this particular number. And the good thing is, if I look at this income as a proportion of the beginning of the period market value, we call it as economic rate of return. Economic rate of return, I will get 94,000 divided by 875, which will exactly be the same for each of the years as your weighted average cost of capital. So that is what is the relationship that exists between your economic income. So we have to be comfortable in all these rounds. right? If at all the weighted average cost of capital is given, right? If at all I know the weighted average cost of capital as well as the market value in each of the years, I should be able to compute economic income, and from there compute the market values of each of the years. All this kind of analysis should really be completed once I know the weighted average cost of capital for each of the period. So the economic rate of return is nothing but the economic income divided by the weighted average cost of capital. So the market value of the assets is going something like this. So from here I can very well go with the debt, right, coming outside this scope. Now the value of the debt in each of the years has to be maintained at 50%, right? The debt in each of the years has to be maintained at 50%, which will work out to these kind of numbers, because this numbers will help me to compute the interest rate, right? To compute the interest and then compute the accounting income. So when I go with the aspect of accounting income, until the EBIT there I will keep it the same, I will pull it from there itself. Until the EBIT nothing change, but from the EBIT we subtract the interest. So what we will take is, this is the debt. So on the top of this debt we have to take out the interest. So on this debt we are computing the interest at the rate of 7%. So which means interest is going to the extent of 30,000 in each of 30, 27 kind of numbers. So based on this I'll get my EBT, which is nothing but EBIT minus interest. Okay, this is just a typical profit and loss statement. EBIT minus the interest is going to give me the PBT, EBT, whatever it is. EBT is going to be this number, and to this EBT I remove the tax. So probably net income is nothing but post tax of this particular EBT. So this number into 1 minus tax rate 35%. This is what is going to be the accounting income. This net income, whatever I am getting, is what I am calling as net income. This is before the salvage. Net income after salvage is more or less for each of the years. There is not much of a difference, but only for the final year I will add up the post tax salvage value also to this net income. So this part is added. So these are the accounting incomes, whereas these are the economic income. So initial periods we are seeing that the economic income, or across the period we are seeing that the accounting income, initial 2 years it is much lesser, but after that it is growing up, right? Accounting income in the initial years it is much lesser, but after that it is going up, whereas when it comes to the economic income, it is decreasing year over year. So because the accounting depreciation, I mean it's an issue with respect to accounting depreciation also. It is based on the cost of the original equipment, original investment, whereas when we are talking about economic depreciation, it's a change in the market value. So though the accounting depreciation is constant across each of the years, whereas in the economic depreciation case we are seeing that it is much lesser in the first 2 years, but after that it has depreciated quite heavily. That's what is contributing to very low economic incomes in the later stages, whereas accounting income has been growing up year over year. That is one way we look at That is one way we look at the differences between economic income and the accounting income. All right. Then, so this is how we have to evaluate both these computations. In the initial years, we may find economic income much higher compared to that of accounting income, and economic income also will help us in deciding the weighted average cost of capital, because economic income divided by the beginning of the period market value of the assets will produce the weighted average cost of capital itself. All right, let's move on to one more concept. In this case, we talk about a few more mechanisms to evaluate the capital projects. To evaluate or to compute the NPV, we have a few more mechanisms, for which I'll use the same example so that you can correlate much better with the example. Right? We talk about an economic profit based approach, we talk about a residual income based approach, and we talk about a claims valuation based approach. Let's look at each of these approaches in detail. Right? So the economic profit is based on the concept of net operating profit after tax, which is nothing but EBIT into 1 minus T, minus the dollar WACC. Dollar WACC is nothing but whatever is the WACC multiplied by the capital that is there, which is the accounting capital, and which is the accounting capital that is available. So from that standpoint, for this example, right, I will compute the economic profit. For the same example, let's say I want to compute economic profit. All I am going to take is the capital in each of these cases. Okay, initially I have started off with 600,000. Right, the capital in this particular period is 600, and because we are depreciating it at the rate of 120, because it's the initial investment is 600,000 and I am reducing it and I am depreciating it by 120. So in each of the years my capital is getting reduced by 120,000 by the amount of depreciation. So this is what will become my initial capital per each of the years. And when I am taking the net operating profit after tax, which is nothing but EBIT into 1 minus T. So in each of these years I am taking EBIT into 1 minus T. T is 35%. So EBIT into 1 minus T forms my net operating profit after tax. And when I look at dollar WACC, which is nothing but whatever is my capital multiplied by the weighted average cost of capital. And when I am taking this as the dollar WACC, so these are the expected returns. The way I should look at it is, here let me put dollar. So the way I should look at it is, in this year, this project has generated a net post-tax operating profit of 78,000, whereas all the investors together are expecting 64,650. because investors totally have invested 600,000, right? Investors have totally invested 600,000, and out of that 600,000 there is an expectation that 10.78% is the return overall they are expecting, which means when I turn it into the dollar amount, it is 10.78% of 600,000, so they are expecting 64,650 in the first year, whereas the project has generated a post-tax profit of 78,000, right? Post-tax operating profit of 78,000. So the difference between this is what is my economic profit. Simple. The difference between the two is what is my economic profit. Straightforward. 78,000 minus 64,650 working out as economic profit. So these are the economic profits for each of the years. So I can very well compute the NPV of these economic profits discounted at the same weighted average cost of capital, right? When I am discounting this at the weighted average cost of capital, these economic profits, I am going to get around 266,141 266,141, and when this is actually called as the market value addition also. So the total value of the project is nothing but this plus whatever is your initial investment, 600,000. So when I am working that out, it is coming out to 866, which should match here. Okay, here the NPV is coming out to 275, whereas here for us it is working out to 266. Actually it should come out to be the same. What has gone wrong? Alright, here in this year, when I am computing the net operating profit, I should also include the salvage value, right? So either I should add up to this number, I add up the post-tax salvage value benefit, which is that 16,000 also, then I should see, yeah, now I am getting 275,882, which is the same as the NPV that I have got through this approach also, which means I can very well find out the NPV of the project based on the economic profit approach. Economic profit is nothing but look at the capital that has been invested, which is nothing but based on the asset depreciation, book value of the asset depreciation, you take the capital, then the net, which is nothing but return on asset. So the asset value, probably instead of capital I will call it as asset. That would be more easier for you to understand. The value of the asset is coming out to 60, 600, 480, something like this. And dollar WACC is nothing but whatever is the return that you are expecting on the total assets, which is working out to that particular number. And NOPAT is which is EBIT into 1 minus T. Remember that you have to take into consideration the salvage value also, otherwise we will end up into this kind of issue which we got slightly some time back. And whenever I am talking about the total value of the project as of today, it is nothing but the NPV that I have got plus the initial investment, which means even the economic profit approach will help me in deciding whether a particular project needs to be accepted or not. So this is one method we have to be comfortable with. Then the next method on the same lines that I would be looking out for is the residual income based method. right? The next method that we are going to look at is the residual income based method. Here the only difference is I will not look at the total capital. I will only look at the equity investors portion of it. So this is purely from the equity investors standpoint. Whenever I use the word residual income, it is nothing but what is the excess of net income over what is the expectation of equity investors. So the expectations of equity investors is simply computed as whatever is the return on equity multiplied by what is the equity capital that is there in the business. Out of the total assets, if I remove the debt portion of it, I will get the equity capital or the net worth that is present in the business, right? From the accounting standpoint, right? So I know that these are my debts, right? I know that the total assets are something like this. So total liabilities plus owner's equity should be somewhere equivalent to this, but I came to know that the debt is something like this. So the equity portions of the investments per each of the years, right? The equity portion of the investments per each of the years, which is nothing but the net worth, based on those two, I can very well compute the net worth in each of those years, which is nothing but the value of the asset minus whatever is the debt. From the book value standpoint, the net worth is this much, right? The net worth is this much compared to, based on the market values when I am going, the net worth in each of these years is going to be something like this. The first year, second year, these are the net worth, or probably this is at the beginning of the year, right? These are the net worths at the beginning of the year. So probably let me look at it more like from this period. Let me see, 400,000, 600,000 is the capital, and 200 and 300 and what is that, 437,000 is the debt. So the difference between the two is working out as the net worth. So the net worth is going to be positive in this particular year, whereas slightly it is going to be negative in the fifth year. Let's look at it. The net worth is going to be negative in the fifth year, going with this combination of assets and liabilities. Now when I am trying to compute the return is computed based on the 17%, right? So first I will take the net income for each of the years, which is nothing but the residual income. From here I will compute the residual income. So the net income, which is from the economic income, we are taking it as these are the net incomes of each of the years. Fair enough. And I would also try to compute the return, the expected, which is nothing but equity charge. The equity charge is nothing but whatever is the percentage the equity investor is expecting multiplied by the net worth of the equity. So the equity investor is expecting 27,000 here, and if I go along, these are the expectations of the equity investors based on the equity charges. And from here I will be getting my residual income. What excess the company, the equity profit is, or the net income is above the expectations of the equity investors corresponding to the equity capital that is present. So the net income minus the equity charge is what is contributing to the residual income in each of the periods, and discounting this with, I'll not use WACC now, these cash flows, these residual incomes, I will discount them with the cost of equity to arrive at the NPV part. I will discount this with the cost of equity to arrive at the NPV part. So all I can do is I'll find out the NPV at the rate of 17% with these cash flows. This is resulting again in 275,882 itself, which is the same as what we are able to derive using the economic profit approach. The only thing here is I have to be quite comfortable with the book value of equity, which is nothing but net worth. I should be quite comfortable in computing the net worth or the book value of equity. Then look at the net income, the charge to the equity, which is the expected whatever is the book value of the equity at the beginning of the year multiplied by the cost of equity, giving us an equity charge, the difference giving me a residual income, which is again helping me to determine the NPV for the period. So even this is another approach that can be used to compute the NPV for the particular project. And finally, I also have a claims valuation approach. This is an interesting approach. I have a claims valuation approach wherein I separate out the bonds as well as equities. The bond investors as well as equity investors, their cash flows I will separate, and based on that find the present value to the bonds as well as the present value to the equity investment. So when I am looking at the bonds, my focus is on principal as well as equity interest benefits which the bond investors are getting in each of the years. Okay, what is the principal repayment? Look at the change in the debt. The change in the debt is what will contribute to the principal repayment in each of the years. So if I look at the debt here, the change in the debt, because initially it was 437,000, but in the next year the debt is only 386, which means the remaining portion 51,000 would have been paid as a principal repayment. So for all the 5 years I will consider that these are the principal repayments. And for the interest repayments, so we are looking at it as the benefit which the bondholders are getting in each of the periods. The benefit that the bondholders are getting in each of the periods, the principal repayments, and what is the interest benefit that they are getting. This is the interest benefit that they are getting in each of the years. So the total benefit which the bondholders, total cash flow to the bond investors, is the summation of the principal repayment as well as the interest repayment, resulting in these numbers. And all I can do is I can discount these to the present value by using the cost of debt. The cost of debt in our case is 7%, right? I'll use the cost of debt mechanism. That's 7% itself, right? Yeah, 7%. So the cost of debt for me, NPV, whatever I am trying to do, I will find the NPV using the 7%, which is the cost of debt, and I look at these cash flows. So the NPV of the debt is coming out to 437,941, The same logic I can do with respect to equity investors. Right, for equity investors, how do I compute the cash flows? Net income plus depreciation minus the principal repayments. So for the equity investors, if I have to find out the cash flows, so total cash flow to equity investors, I'll look at the net income plus depreciation. So these are the net income plus depreciation minus whatever is the principal repayment that I am doing. So this is the total cash flow that is available to the equity investors in each of the years, which can be paid in the form of dividend. Assuming that everything is paid, I can discount these cash flows at again the cost of equity now to arrive at the NPV. I'll discount these at 17%, and this is what will give me the total value of the equity, which is again the same, and the summation of these two will give me the total value to the firm, the sum of value to the equity plus value to the debt investors. So this should be again matching up with the total value of the firm. Out of that you remove your initial investment, it will give you the cost of, it will give you the total NPV for the project. So whatever is the mechanism that we are typically using to find out the NPV, there are so many mechanisms like your economic profit based mechanism or residual income based mechanism or claims valuation based mechanism. Whatever is the mechanism that we are using to compute the NPV for the project, what we are observing is in all the mechanisms, if at all we are doing our calculations correctly, the NPV will come out to be the same across. Right? So these are the various basic mathematical calculations that are involved as far as the evaluation of capital projects is concerned. I hope you got a good amount of understanding into various of these mechanisms. You can very well practice out with the spreadsheets that I have, as well as you can understand the process well with the spreadsheet example which I have taken. In case you have any further clarifications regarding the same, you can very well get back to me by giving me a call on the number that I have provided below, 98480-12123, or you can send in an email at vamsidhar@pacegurus.com. I'll get back to you with the relevant clarifications for the same. Thanks a lot for listening to this session. Thank you very much.